Major silver market. Update. CME margin. Changes and what they mean for investors. Good morning. This is February 13th, 2026, and we need to discuss significant developments in the silver market that occurred overnight. If you hold silver positions or you're monitoring precious metals markets, this information is critical. What happened overnight? At 10:45 p.m. Eastern Time last night, the CME Group issued an emergency notice that fundamentally changes the landscape for silver futures traders. Let me walk you through the specifics because understanding these changes is essential for anyone with exposure to silver. The maintenance margin requirement for COMEX silver futures, the SI contract representing 5,000 troy ounces, has been raised from $14,000 per contract to $23,500 per contract. That's a 68% increase implemented immediately with no advance warning or phase-in period. For those unfamiliar with margin requirements, think of this as a security deposit. It's the capital you must maintain in your account to hold a futures position. When margin requirements increase this dramatically, and this suddenly, traders who can't meet the new requirement face forced liquidation of their positions. This isn't the first margin adjustment we've seen recently. This marks the third increase in less than 3 weeks. Previous hikes occurred in late January when silver was trading above $120 per ounce and again on February 6th. The pattern of increasingly frequent and larger adjustments is noteworthy. Dusters, the broader context. To understand why this matters, we need to look at the current state of COMEX silver inventory. According to exchange data, registered silver, the metal actually available for delivery against futures contracts, fell below 100 million ounces on February 11th. The current figure stands at approximately 98.13 million ounces. That represents a 41% decline from October 2025, when registered inventory stood at 167 million ounces. More concerning is the acceleration rate. Roughly 3 to 5 million ounces are leaving the vaults daily as entities take delivery. Meanwhile, the March 2026 contract has open interest representing approximately 515 million ounces in paper claims. That's more than 5 paper claims for every physical ounce in registered inventory. Rule 594B, the delivery restriction. The margin hike wasn't the only change. Buried in the emergency notice was the invocation of Rule 594B, which restricts non-commercial entities from standing for physical delivery in the March 2026 silver contract. In practical terms, this means that if you're classified as a speculator, essentially anyone who isn't a registered bullion bank, refiner, or approved commercial dealer, you're now prohibited from taking delivery of physical silver in the March contract. Previously, any contract holder could demand physical delivery. That's a fundamental principle of futures markets, the right to convert a paper contract into the underlying commodity. Rule 594B eliminates that right for non-commercial participants. This raises an important question. If supply were abundant, why restrict who can take delivery? The market impact and price movement. The immediate market reaction was significant. Silver had been trading around $84 per ounce on Wednesday. By Thursday afternoon, it had slipped to $81. Following the margin announcement, silver dropped to $76.20 during the overnight session, nearly a 10% decline. But here's what's important to understand about that price movement. It wasn't driven by fundamental changes in supply or demand. Not a single new ounce of silver was mined. Industrial demand from solar panels, electronics, and 5G infrastructure didn't change. What changed was the regulatory environment, which triggered forced selling when margin requirements increase 68% overnight. Many traders simply can't meet the new collateral demands on such short notice. Their positions get liquidated automatically, creating artificial selling pressure in a thin overnight market. Who's accumulating? While retail traders faced margin calls, institutional players were in a very different position. Major entities like Tether, which holds 148 tons of physical gold, worth approximately $23 billion, don't face the same constraints as leveraged retail traders. We're also seeing persistent premiums in Asian markets. Shanghai silver has been trading at approximately 10% over COMEX futures, a spread that typically signals physical shortage. In 2025, total COMEX silver deliveries hit 474.4 million ounces, more than double the 202.7 million delivered in 2024. This metal is flowing somewhere, primarily eastward, into Chinese industrial stockpiles and sovereign reserves. Understanding the timeline today is February 13th. First notice day for the March COMEX silver contract is February 27th. That's 14 days from now. Consider what's already occurred. 3 margin hikes in 3 weeks, delivery restrictions through Rule 594B, and accelerating vault drains. The exchange has deployed significant regulatory tools already. Industry analysts expect delivery demand of 70 to 80 million ounces minimum for the March contract. If registered inventory continues draining at 3 to 5 million ounces daily, we could see available supply in the low 80s or even 70s by first notice day. That's not speculation, that's arithmetic based on current drain rates. What this means for different market participants. If you hold physical silver, coins, bars, allocated metal in secure storage, the overnight margin changes don't directly affect you. Your metal remains yours. The fundamentals driving the supply deficit haven't changed. If you're holding paper silver products, particularly leveraged positions or futures contracts, you need to understand that the regulatory environment can and does change rapidly. Last night demonstrated that exchange rules aren't fixed. They adjust in response to market stress. The key question each investor must answer: are you comfortable with paper exposure that can be cash settled rather than physically delivered? First, looking ahead. We're entering a critical 2-week period. The combination of declining registered inventory, high open interest, and recent regulatory changes creates an unusual market environment. Several scenarios are possible. The exchange could implement additional measures, physical premiums could widen further, or we could see orderly settlement as commercial entities work through the delivery process. What we know with certainty is this: the physical silver supply available for delivery is finite and declining. The exchange has already taken significant steps to manage the delivery process, and we're 14 days from first notice day. Action items for physical holders. Understand that overnight price volatility in futures markets doesn't change the long-term supply-demand fundamentals that drove your initial investment thesis. For paper holders, review your positions, understand your counterparty risk, and ensure you're comfortable with potential cash settlement rather than physical delivery. For those watching from the sidelines, this is a real-time case study in how futures markets function under supply stress. We'll continue monitoring COMEX inventory data, Shanghai premiums, lease rates, and regulatory filings. The next 2 weeks will provide crucial information about the relationship between paper markets and physical reality. Subscribe to stay updated as this situation develops. The February delivery period will answer important questions about market structure and physical availability. This is your silver market update for February 13th, 2026. Stay informed, understand your positions, and make decisions based on facts rather than fear.